Finance, in its purest form, is the art of efficiently allocating resources. Throughout history, this seemingly simple act of moving money has driven the world forward. We began by bartering goods directly.
It's like the old saying, an eye for a tooth, a nose for a chin.
A sack of wheat for a bunch of bananas, rice for milk. You get the picture. This simple exchange evolved into the trade of more durable commodities like flocks of sheep, salt, and other materials. As societies grew more complex, the need for a standardized form of exchange became clear. Precious metals like silver and gold, with their inherent value based on weight, seemed like the answer. However, these metals presented challenges: inconvenience, minting costs, limited supply, and fluctuating value. Humanity's desire for both wealth and a stable system of exchange continued to grow. As borders blurred and connections expanded, a new idea emerged: a universal medium of exchange, a piece of paper made valuable solely by our trust in a governing body. And then came the unthinkable. In recent times, we've witnessed the exchange of pizza for 10,000 bits of a digital currency. This new system relies on a consensus mechanism, storing transactions in blocks secured by complex mathematical puzzles. While highly secure, it hasn't been without its pitfalls, sometimes exploited by those seeking a quick fortune. From commodities to metals, paper, and now the digital realm, the medium of exchange has undergone a remarkable transformation, and it will surely continue to evolve. Today's financial system may seem bewilderingly complex. We've become adept at both efficiently allocating resources and, well, misplacing them. Deciphering the meaning behind all these numbers, reports, ratios, contracts, and loopholes can feel overwhelming. And to be honest, it is. Yet some core principles remain constant. The need for a financial system. We understand the necessity for a standardized form of exchange like money, but why a system? The answer is simple: information symmetry and convenience. Sure, we could all theoretically buy, sell, lend, and borrow directly, but that's cumbersome. Imagine needing a loan to build a house. You wouldn't likely find a single lender with the entire sum. So, you approach multiple lenders, each with their own requirements and interest rates. Tracking all this debt and dealing with individual lenders would be a nightmare. From the lender's perspective, managing numerous loans and ensuring repayment becomes a logistical maze. The other issue is information asymmetry. This occurs when one party has a significant knowledge advantage, leading to unequal bargaining power and potentially unfair outcomes. The financial system. It's the invisible engine that greases the wheels of our economy. Imagine a world without it. People hoarding cash under their mattresses, businesses struggling to find funding. A financial system allows for the efficient transfer of funds, solving those problems and creating a smoother flow of money. To grasp how it all works, let's break it down. First, there are the financial markets. Think of them as giant marketplaces, either physical locations or online, where financial instruments are bought and sold. Stock markets, bond markets, money markets, these are all examples. They provide liquidity, meaning there are always buyers and sellers ready to make a deal, which is crucial for urgent trades. But that's not all. These markets also help determine the price of a financial instrument through the constant dance of supply and demand, a process called price discovery. Now, who participates in this financial game? There are issuers, the creators who sell financial instruments to raise capital. On the other side, we have investors, the folks who buy those instruments, hoping for a return on their investment. Financial instruments come in two flavors: debt and equity. Equity represents ownership in a company. Owning equity entitles you to a share of the company's profits and potentially some capital gains if the stock price goes up. Think of it as a piece of the pie. Let's use Coca-Cola as an example. In 2024, they continued their tradition of rewarding investors with a dividend of 485 cents per share. That means if you owned 100 shares, you'd get a cool $48.50. These dividends are a double win. They attract investors seeking steady income and signal Coca-Cola's confidence in their future. Debt instruments, on the other hand, are like IOUs. A borrower, the issuer, promises to repay the lender, the investor, also called a creditor, with interest over a set period. Unlike equity, which has no fixed maturity date, debt comes with a deadline. That's why they're sometimes called fixed income instruments. Enter the intermediaries. Maybe you have some extra cash to invest, but lack the time or expertise to navigate the financial maze. That's where financial intermediaries step in. These are like your financial guides, helping you invest your money wisely and providing a decent return with lower risk. They also ensure everything stays kosher with regulations. Banks, insurance companies, and even mutual funds are all examples of financial intermediaries. Mutual funds, the power of many. Let's delve into mutual funds for a moment. They operate on the principle of pooling resources. Say you would like to invest $100, but also want to diversify. You break your dollar into 20s and invest in 5 stocks. But imagine there are 3 people like you with $100 and you pool in your money. Now, if you break it into 20s, you can invest in 15 different stocks. This increases the chances of making a return and also reduces the risk in the process. Mutual funds work in a similar way. They pool clients' resources and invest it for them, giving them a better return. Let us understand why diversification works. Imagine you want to diversify your portfolio, which reduces risk. Think of it like rolling a die. The odds of getting one are about 16%. But if you roll 6 dice, the chance of at least one die landing on one increases dramatically. Mutual funds work similarly by spreading your investment across multiple assets to mitigate risk. Of course, professional investors don't just throw darts at a board to pick stocks. They consider return rates, potential risks, and do thorough research before making an investment decision. Finally, the guardians of the financial system, the regulating bodies. These guys, as the name suggests, regulate. Their mission? Protecting consumers, ensuring the overall stability of the system, setting standards, and keeping an eye on market activity. Think of them as the referees, making sure the game is played fair. In India, we have SEBI Securities and Exchange Board of India and the Reserve Bank of India. The US has similar entities like the Securities and Exchange Commission and the Federal Reserve System. These 3 components, financial markets, regulators, and intermediaries, constitute the capital markets, and the study of them is called capital market theory. The use of capital market theory is to make investment decisions, risk assessment, portfolio optimization, and determine market efficiency. Market efficiency is a measure of how well the information available about an asset is reflected in the price of an asset. A price-efficient market simply means that all the available information is already impounded into an asset's price, so an investor is expected to get a return that compensates proportionately to the risk he undertook. Market efficiency are of 3 types: weak form, semi-strong form, and strong form efficient. Weak form efficiency. This is the most basic form of market efficiency. It suggests that all past information, including historical prices, trading volume, and past news events, is already reflected in current asset prices. The implications? Technical analysis, which relies on studying past price and volume data to predict future price movements, is unlikely to be effective in a weak form efficient market. Semi-strong form efficiency. This form builds on weak form efficiency and proposes that all publicly available information, including past information, current news events, and company filings, is already reflected in asset prices. Implications for this type of market is that fundamental analysis, which involves researching a company's financial statements, industry trends, and competitive landscape to assess its value might not lead to consistent outperformance in a semi-strong form-efficient market. However, fundamental analysis may still be useful for identifying companies with strong long-term potential. Strong form efficiency. This is the most stringent form of market efficiency. It suggests that all information, including both public and private information, like insider information not available to the general public, is already reflected in asset prices. In a strong form efficient market, even insiders with access to non-public information wouldn't be able to consistently outperform the market. This form of efficiency is generally considered unrealistic, but it highlights the limitations of trying to exploit any single source of information for market gains. With that, we have come to the end of this video. I tried to make it as concise as possible and touch on concepts that will build the foundation for understanding finance down the road. If you liked the video you just watched, please like and subscribe. I will be uploading more finance-related videos in the future discussing financial strategies, financial statements, valuing assets, and more. Thanks again for watching and have a good one.